Hello and welcome to another series with one of my favorite people to talk about all things housing market and economics. This is Ian Mullen. You are the branch manager of RWM Home Loans here in Bellingham. Thank you so much for coming in today.
Yeah, thanks for having me in. I always love to have a pulpit from which to be an economic nerd. It's one of the only places I can do that.
So you and I email back and forth or text back and forth every so often, usually talking about my house because I'm a little self-centered that way about situations, but I always like getting Ian's perspective on larger economic factors because you seem to be one of those people that doesn't just focus on Whatcom County, doesn't just focus on home loans and sales, but on larger economic education and elements that can factor into someone's loan and what it might look like over the 5, 7, 15 years that they have that loan. So we had talked back and forth about some different topics, and you brought up a word I had never heard before.
Yeah.
So what is that word, and what's the short definition of what it means?
Yeah. So the word is stagflation, and I brought it up because we're going to see it coming up more and more often in the media as we head into 2024, with some analysts expecting that we will enter into a stagflationary environment by the middle of next year. There's obviously no guarantee that we're going to end up in such an environment, but it's good to know that it is a potential economic environment we could be entering, and when you start seeing it in the news, it will probably be surrounded by fear. And it's not necessarily something to be terrified of. It's just something that you should understand in case we ended up in that environment.
And I so appreciate you saying that because we always want to provide information, education, so then people can make the best decisions if they are making housing decisions for their specific situation. But why is it a word that has fear associated with it?
Yeah, well, partially because it's largely unknown. I mean, even me, I know about it very well, but I've never lived through a stagflationary environment. And the previous stagflationary environment that we'll talk about in a little bit here preceded a period of significant economic difficulty for a number of years. Economics are an interesting thing in that it is a science, but it's a very soft science. It's really more human psychology and sociology than it is a hard and fast formula for what could or will happen. And so understanding what could happen is a valuable skill to have, but you should not trust anybody who says these are the things that are going to happen because of these following triggers.
Which I think is really important to point out. Sometimes I can think of, because I don't understand economics on this large scale, you sometimes get this feeling of, okay, there's this lever that pulls this way and it will do this other thing. There's this lever, and then the Fed and other deciding bodies just sort of move levers around and decide what the economy will look like, but that's not really the case.
I always know the difference between a good economist and a salesperson by their choice of verbiage. Good economists, and my favorite analysts, use words like should and may and are likely to, whereas salespeople are going to say, oh, interest rates are going to go up, so housing prices are going to fall because it's a simple supply and demand. In reality, this huge global economy that we're in is made up of individual human beings, and human beings do not make subconscious decisions in a reliable way. And so the economy, we can make guesses on what should or may happen, but no one can accurately say what will happen. Maybe Chairman Powell.
Right.
He's not making such predictions right now, though.
So what are the characteristics of a stagflationary environment?
So stagflation is an environment where inflation is relatively high, unemployment is relatively high, but gross domestic product or economic activity is relatively low. It's unusual, and it shouldn't, if you follow the rules of economics, it shouldn't ever exist, because generally speaking, high unemployment and high inflation results in consumers spending less, and it generally is a situation which brings itself back into equilibrium. I think the best way to understand what stagflation is and how it could occur again is by understanding how it occurred in the past. And fortunately, the United States has only been through a stagflationary period once in our history. It was in the late 70s. The 70s were funny because it wasn't a bad economy. It was just kind of a period of general economic malaise. It was bad, but not terrible. So in the 70s, in the US and the UK, we saw relatively high inflation. I think core inflation was around 6.5% to 7%. Relatively high unemployment of about 5.5%. And then pretty uneven economic activity. It was just rather unsteady. And it created this environment where a trigger occurred which caused inflation to really substantially go through the roof. And what makes stagflation scary, and the fear that you're going to be hearing when you're listening to the media talk about inflation or stagflation, is that the Fed has only one tool to control stagflation, and that tool is to grind the economy to a halt, basically hit reset. And so in the 1970s, it was this period of economic malaise, and then things started to get a little bit out of control in 1979 with a significant petroleum embargo and the fall of the Iranian government as we know it. There was a whole coup that overthrew the Shah and really impacted our ability to access petroleum. And that is the key that must always kick off a stagflationary environment, is where you have relatively high unemployment against relatively high inflation, which is an environment we're in right now, although we'll talk about the differences between us and 1970s in a little bit here. But then there needs to be a trigger that really suddenly jacks up your inflation figures. In the 1970s, that was the rising cost of petroleum. And we think about petroleum now as, if the cost of petroleum goes up, then it's going to be more expensive to drive, in which case I will just drive less, or, now we can work from home and all these things. What you don't realize is that rising petroleum costs impact the cost of every good you purchase, because your glass holding that water did not come from Bellingham. Right. It came from China.
This wasn't
probably
hand-blown
maybe
here downtown Bellingham. I wish.
It's quite possible. But even if you personally consume no petroleum at all, what you do consume required petroleum to get here.
Yes.
So that spike in petroleum prices jacked up the cost of all goods across the US and the UK, and it created an economy where inflation was really running out of control. And then Chairman Paul Volcker was somewhat villainized for essentially intentionally causing a recession, saying inflation is out of control. The best way to get inflationary costs down is to just slam the whole thing to a halt. And he jacked up the Fed funds rate, which we've been seeing rise over the last 18 months or so. He increased it. I don't remember how high the Fed funds rate got, but the prime interest rate, which is a direct correlation to the Fed funds rate, got up to about 21%. Our Fed funds rate is sitting at about 5.25, 5.5, and I think prime is about 8 and change currently. So our Fed rate and our prime rate have been much higher than they are right now, as uncomfortable as these current rates are. Right. Could get a lot worse.
I think the national average, isn't it right around 8.9 as far as since it's been tracked?
We've been enjoying artificially low rates for a very long period of time. So most of us, I've only got into finance just before the recession in 2008. And so most of my adult working years, even in finance, have been in an expanding economy, relatively low interest rates, lots of economic productivity. And the Fed has done maybe too good a job of fending off light recessions. So the worry is that if stagflation does occur next year, the Fed's only tool to combat it will be to induce whatever recession is necessary to bring stagflation into control.
So with petroleum prices being almost the inciting incident or trigger in the 1970s, would you say we have already experienced our inciting incident?
Not yet.
Or what is that coming? Okay.
This is speculative again, so don't hold me to this. But
we're holding you to it. You get out the crystal ball. Here we go.
I hope I'm not right. My concern is that versus the 1970s, we are reliant on petroleum, but our relationships in the Middle East are better now than they were then. And we have significant petroleum reserves that the last couple of administrations have been willing to tap into as needed. So a spike in petroleum prices could be hedged without necessarily inducing a recession in order to bring things into control. What I think is going to be, if we experience stagflation, its cause, I think, will be rapidly rising housing costs, and not related to mortgage costs to consumers, but related to the cost to borrow money on a commercial standing. So since the Fed has been increasing all of these rates, the rate that they're increasing is called the Secured Overnight Funds Rate. It is the rate at which big institutional investors borrow money from the government and then lend it out to their commercial clients, basically. all these Fed funds rates are requiring banks to increase their cost to borrow to their clients, which are big commercial borrowers, people who are financing 5+ unit homes. In some cases in Bellingham, that could be big property management firms with 100 unit apartments downtown. But nationally, a significant number of people living in rentals are renting from large commercial entities. The interesting thing with commercial loans is that the loans against these properties have locked in rates for definitely not less than 1 year, but for up to 5 years. So all these secured overnight funds rates have increased the cost to borrow for the banks who are borrowing from the government, but those impacts have not yet been experienced by most commercial borrowers because their rates are locked in at a date before these interest rates started rising. So
sorry, just to clarify, is this like a commercial, so this is a adjustable rate situation where they locked in a rate for 5 years, but it's a 30-year loan and the rates will adjust each 10 years or something. Just, okay.
Yeah, so most commercial loans have rates that are locked in for anywhere between 1 year and 5 years. Yeah, and so there have been some notes which have been renewed in the last 18 months since the Fed started increasing their rate, and those loans have already been impacted by these secured overnight funds rate increases, but the vast majority of commercial loans in the U.S. have not yet gone through a refinance or a rate adjustment on their commercial notes. So what is going to happen as these Fed rate increases continue to impact commercial loan renewals, these commercial borrowers who own these apartment buildings are not going to just take the loss of the higher interest rate. They're going to increase their rent plus probably a 10 or 15% margin in order to cover the increased interest rates. Now, as you know, housing, especially in our local area, is already very expensive. But what we are going to see, like let's say you were a commercial borrower and you borrowed a $4 million loan from JP Morgan at 5.25% 2 years ago, and it's a 3-year note. Well, next year, that rate is going to go from 5.25 to 10.25. And on $4 million, you're talking about it's a very, very, very significant increase in interest cost, and that's going to be passed directly to tenants plus a margin. The scary thing with higher rent costs, higher housing costs, that is a threat to our economy where petroleum wasn't to the US and UK economies in the 1970s, is that it takes a long time to reverse those. So if all these commercial loan renewals do result in higher interest rates on commercial loans and then in turn result in higher rents, the impact that is going to have to the economy is that consumers are just going to not have any extra money, assuming they can pay their rent at all. There's not going to be a whole lot left over, and the whole economy really relies on money changing hands multiple times in order to keep it moving forward. Well, if nobody has any discretionary spending, the whole economy can suffer greatly. So what will happen next year, if all these commercial notes renew and it's at 4 or 5% higher than their previous rate, we're going to enter into a very, very rapid kind of a constriction of the economy as that money multiplier really is reduced. Scary thing with that is that the only thing that the Fed can do to reverse that impact on commercial loans is bring their federal funds rate back to as low as zero, where it was 2 years ago. Trouble with that is that the reason why it's as high as it is because they're combating inflation. If they reduce their Fed funds rate, inflation is just going to catch on fire again. We're going to go crazy. So in this case, I don't think the Fed has the power to stop a recession from happening if we enter into a stagflationary environment. It's going to have to take care of itself. And when you're not in control of the recession, we just don't know how bad it could be. Yeah, at least in the 1970s, we knew these are the steps that Fed Chairman Volcker is going to take, and this is what it's going to do to the economy, and it's going to be bad, but it should only be bad for this period of time. And then here's how we expect to crawl out of it. It was a controlled recession. This recession that's driven by higher housing prices, it's going to be much harder to control. On the bright side, it does look like most leading factors that would result in stagflation are more or less under control. The reason why analysts are bringing it up is because there are some weird economic interpretations of studies that are not really super accurate. So we largely track unemployment as a measure of the health of an economy. Unemployment is very low. It's below 3% right now, which is really where you want it to be.
Right.
But what unemployment doesn't take into account is people working less or getting paid less relative to the cost of goods.
Right.
So while unemployment itself is a really, really low figure, for the last year and a half, we've seen number of full-time employees dwindle. Basically, every employee, on average, every employee in the country has lost more than an hour of their pay every week, while wages have declined and inflation has risen. So not only are people getting paid less in actual nominal dollars, those dollars are not going as far. So inflation is not... The inflation figures that the Fed is paying attention to as they're talking about these rate hikes is not really the figure that they should be looking at in terms of where the rubber meets the road.
Gotcha.
Yeah, so we'll see. This Fed is not acting in a way that Federal Reserve banks typically act. They appear to be a little bit more politicized than we usually like our Fed to be. And it does appear that they are intentionally looking away from financial markers that economists wish that they would actually look at.
So looking ahead at the possibility of a recession, looking at where our economy is right now, what approach or kind of financial position should a renter be considering? Or should a homeowner be considering?
Yeah.
You know, you said this would constrict the economy as a whole. So I'm a homeowner. Does it not affect me? Or it will affect me because it's the entire environment.
Yeah, well, good news, bad news.
Yeah.
Good news is if you own a home with a fixed rate, which almost everybody does, your housing costs are known,
Right.
Not likely to change significantly in the next few years. So if you can afford what you're doing now, job security is the next thing that you should focus on. And fortunately, the U.S. labor market is fairly robust right now. We could see a decline in number of hours worked, but it's not likely that we would experience mass unemployment in our industry, at least. For my clients who are in more credit-dependent industries like technology, I would start to be fairly conservative with my finances. You know, it's funny. I guess the good advice going into a recession is the good advice all the time.
Always.
It's just nobody goes broke by being conservative. Spend less than you earn. Be a good saver and make good decisions.
Right.
Lean on the advisors that you trust. Going into a recession, especially a recession like this, cash reserves are going to be very important. It doesn't hurt to get into a slightly more financially conservative mindset before you have to.
Right.
Maybe start cutting some of your discretionary spending now, knowing that you might be forced to next year. Just get your lifestyle used to it. A lot of people, especially in our industry, have experienced lifestyle creep in the last few years. I can't believe the number of loan officers I talked to who got used to the income that they were earning over the last few years as if it's likely to continue.
Right.
So to those industries more than any, but really to everybody in every industry, I'm stressing the importance of having a budget and sticking to it, and don't run on the knife's edge with your finances. Yeah, make sure you have savings.
What does that mean potentially for renters then?
Yeah, well, that's the renters are the ones that are going to be beaten up in the next couple of years the hardest. Don't mistake this as financial advice saying that buying is the right thing right now. But if you are renting and you're renting from, or if you're renting a unit in a property with greater than 5 units in it, you are going to experience a significant rental rate increase in the next 3 years. There is no way around it unless the Fed brings their secured overnight funds rate down before your building's commercial loan renews. But you can expect, I have a client in town who has a significant number of units, and he's going to be increasing his rent 60% next month because his loan renewed, and he's... most of his leases are up in December, but his loan renewed in March, and his just cost of ownership went way up. He's been running in the red since then, so he has to increase his rent in order to cover those expenses.
Merry Christmas, y'all.
He's not excited about it.
Yeah, exactly. I mean, that's the thing, is it's not a choice that this person is making.
Yeah.
It's a reality of a situation.
Yeah. So to put into focus what the Fed is doing and the impact it's going to have in the economy, this sort of sheds light on some of why I'm so frustrated with this current Fed. Like their goal is to bring inflation into kind of a healthy range, which they say is somewhere around 2 or 3%. The inflation that they're tracking says that inflation is closer to 3.7, so there's some more work to be done. Actual inflation, if you break apart what goes into that core inflation number that they look at, they way underweight the value of shelter costs, housing costs. At least in Whatcom County, significantly more of a client's take-home pay goes to shelter costs than that metric accounts for.
In the Bellingham Housing FAQ website, there's stats available on how many people are, I forget the term, it's something along the lines of housing burdened, where it's above the recommended percentage of your take-home pay goes towards housing. It doesn't mean that it's 50% or 70% of your income, but it's that above, I think it's around 40% or more is going to housing.
So to give you some context, most of these inflationary reports put a weighting of 21 to 27% of their whole inflation figure on the cost of shelter, when in reality, the vast majority of people, especially in our area, are paying substantially more than 21 to 27% of their income on housing.
Including everyone who's closed on a loan in the last 8 months.
Especially them. It's a whole different topic of conversation, but shelter costs are a much more important economic factor than the Fed is giving it credit for. And all of these Fed rate hikes are going to substantially increase that factor much, much more. And the scary thing is that if they're only looking at core inflation and not at really actual inflation, then these impacts of their Fed hikes are going to be much more actually severe than they appear to be on paper. And it's interesting. I mean, a lot of people, particularly in sales, will specifically look for statistics that make it look like they're doing a good job. We don't want that from our economists. We want the opposite. More conservative, the better. So this Fed looking at shelter costs is 21 to 27% of overall inflation is a really inaccurate representation of inflation as a whole. When hot costs go up a little bit, you know, if the actual figure, say 40 to 45% of the average American's income goes to shelter costs, and the Fed is only weighting it at 25%, then an increase in shelter costs is going to be almost double what the Fed is accounting for. And if you don't know what's going into these reports on which you're basing your whole financial policy, fiscal policy, I don't know. It's hard to trust them.
Absolutely.
So as a renter, I would say be prepared for significant rent rate increases. It's not necessarily going to impact everybody. We have tenants, but they're all in homes that are secured by 30-year fixed single-family home mortgages. So I have no reason to raise rent on my tenants. It's not to say that some landlords won't because they can get away with it, but it's not going to happen to everybody. But if you're in a 5+ unit building, you will almost certainly experience significant rent rate hikes in the next couple of years.
So then looking at a season of stagflation, in the 1970s, how long did that last? What brought us out of it or crashed down out of it? You know, it feels like it's this sort of interim, like you're saying, malaise in the economy. What tips you up? What tips you down? What's the exit? Fortunately, by nature of what it is, it can't exist for very long.
It either takes care of itself, which I think if we experience stagflation next year, it will likely be in such a way that the Fed doesn't have a very good grip on it. It will necessarily take care of itself, and the Fed will react to economic events caused by stagflation. Whereas in the 1970s, it was clear that they were in a period of stagflation, and Chairman Volcker induced a recession, knowing that it was going to happen one way or another, so he'd rather be in control of it than not. Chairman Powell, our current Fed chairman, really fancies himself as a Paul Volcker, but he's not acting in the same ways that Volcker acted. Volcker was extremely unpopular at the time. He intentionally crashed the US and UK economies, essentially. And in retrospect, we have the benefit of looking back and realizing it was the right thing. But at the time, he was very, very unpopular. And this much more politicized Federal Reserve, I think, knows that inducing a recession may be the right thing to do, but they're not willing to do it due to the political backlash. I think they're hoping for, they keep using the phrase soft landing, but we're getting further and further away from being able to accomplish that.
Out of curiosity, my very limited understanding of the Federal Reserve is it's a semi-privatized / privatized space. If it's so politicized, but they're not elected officials, why is it a politicized body this time around?
It's a good question. A lot has changed since the 70s. Not a lot of people were on Facebook in 1979. Fed chair members were truly economists, analysts, people who were drawn into the pseudo-government sphere from universities and government positions. Now, Fed chairs need to think about what they're doing after their term in the Fed, and many of them are eyeing jobs, say, with the U.S. Treasury.
Also appointed type positions.
Or maybe they're going to go and consult with large corporations because of their background in economics, and it is important to them what they're going to do after this job, whereas before it maybe wasn't on the forefront of their mind. I think in general, there are economists that really, really take their jobs seriously, but in order to be in a position where you are appointed to be chair of the Federal Reserve is a different path than it was in the 70s.
Yes.
Yeah, the Federal Reserve Bank as a whole is such an interesting institution in that they have a blank check to control money supply, our money supply, the United States money supply, but they are almost entirely a private organization. There is an oversight committee in Congress who pays attention to what the Fed is doing, but the Fed's books are private. They're not to be viewed by anybody. So we get to speculate what's in there and what the Fed is doing financially, but none of us ever really know, which is somewhat terrifying. It's probably the most powerful corporation in the world that nobody ever thinks of. It's spooky. And now that it is increasingly political, it's not to say that Chairman Powell isn't a genius. He's a very, very intelligent man. But his motivations are going to be different than Volcker's motivations were in the 1970s.
There's a certain element of, there will always be, like you said, in this current day and age, there'll always be politicization against sort of that academic honesty or academic integrity. And
and that combined with just, we are in a political age where we sort of talk about Volcker and the president and the people who lead the EU all in the same breath, and they're less individual entities and more the government. So we really do kind of, it's maybe our fault that Chairman Powell is concerned about his self-image, because we have sort of made it so Fed chair is somebody who we feel we should talk about behind his back, like we're doing right now.
At least it'll be public, so he can watch it if he needs to.
Call me Jerry.
Chairman Powell. Nice to meet you. Thank you for joining us today. So for a average consumer like myself who enjoys conversations like this but might feel slightly overwhelmed by this very large story of our world, obviously we talked through kind of budgeting and preparing yourself for ups and downs of the financial world, as we should anyways, which we also discussed. What other, in terms of education or understanding of the economic system, how should we as not only consumers but citizens of our country be kind of aware of what's going on? What resources do you feel are accessible for people like myself, if I don't get to talk with you every other day, to kind of keep track on this sort of thing?
That's a great question. This is going to sound kind of counterintuitive, but if what we have just talked about is not something that people are interested in, they probably shouldn't research it, because it's a very deep and complicated well.
TikTok. There is going to be a person yelling into a screen that tells you exactly everything you need to know in 30 seconds or less, right?
It is that simple.
And then they will have a discount code in their bio.
Why go to university when you can just watch a bunch of shorts on TikTok? I would say if it is something that you are interested in, go and talk to somebody who knows about it. I would say when you're reading articles, listening to the media, and talking to friends and financial advisors, there is some language that I would specifically look out for. Any really good economist or analyst will never use absolute terms. They're not going to say, if this, then that. They're going to say, if this, then we expect the following, or if history is any indication, this is what we can expect going forward. Real economists and analysts understand that our economy is driven by individual people, and individual people do not act consistently. So the last 3 years are a good example. We have entered into an economy that should not be functioning this way, but is continuing to. And actually, given everything that we've been through the last few years, we're functioning pretty well, even though everything on paper says that we should be in a very deep recession currently. We're just not.
We just might be,
because people have been acting differently.
Kind of cruising that direction, potentially.
Yeah. So I would say if you're watching this video and you are interested in what we're talking about, go and find somebody, some nerdy banker somewhere, maybe your CPA, financial advisor, and chat with them about it. If you're not interested in it, then the advice that I would give you is the same advice that we give to everybody all the time. Just act conservatively. Save more than you make, control your discretionary spending, have a budget, really revolutionary stuff. I would say start living your life now more modestly than you need to, so that if we are in a recession for 3 years, starting halfway through next year, you'll be able to live better than you should due to what you've given up in advance. Yeah, nobody ever goes broke by being conservative. Any other final thoughts or words of wisdom or information that you would like to share with the audience that is listening with rapt attention? You can tell I'm starting to running out of questions. I mean, from a high level, just hate to keep rapping on this, but continue to be financially conservative. If this is interesting to you and you do want to talk about it more, I would love some random call from a stranger to talk this about. I really... And you're wonderful to talk about with this sort of thing, because I'm sorry, I'm totally interrupting here, but I'm just going to say, with all of the conversations you and I have had over coffee, over the phone, throughout my entire home purchase, Ian has the ability to explain and then re-explain and then re-explain in different ways that I feel like I can finally understand something, or I can finally grasp it. And then I'll go away and forget it, but that's why I go back in and I double check. Literally, the video you and I did almost 4 years ago, I have gone back, not 4 years ago, 2 years ago, I have gone back and rewatched it in sections of it multiple times, because you not only talked about how the Federal Reserve was operating in that moment, you talked about kind of some of the general structures of the American economy, and I easily forget that sort of thing, so back I go to refresh. Easy to forget. So you're a wonderful person to have coffee or wine tasting with and ask these types of questions. Yeah, I do not really get to talk about the economy very much. Unfortunately, my industry has become less of an advisory industry and more of a sales business. And so most people I talk to are interested in the home in front of them that they're trying to buy tomorrow. And I don't really get to have high-level conversations about the economy in general. And frankly, most of my clients would not benefit from having this conversation with me either. It'd just be wasted brain space. But if you're the kind of person who is interested in this, I will take you out to dinner or something and we can chat about the economy until you're blue in the face. I would be very happy to do that. I love that so much. You're just beaming. You're stoked about this idea. This is not a sales moment. This is an economics nerd moment, and I'm here for it. Don't get to do this often enough. It's important information, but not everybody cares. And if you don't care, you shouldn't pay attention to it, because it's very acidic information. I think that's one of the really key takeaways for all of us is avoiding hype, avoiding fear-mongering, avoiding emotion-based information. Information. It's like infotainment, but it's emotation, yes. I'll come up with a word File for that one away for later. But where it's like a tiny granular piece of information, but then couched in so much hyper emotion because they're trying to sell an idea. Even if it's a product or service, it's selling an idea, selling a narrative. And so thank you for providing a informative, methodical discussion of the topic and for taking the time to explain it for us. Well, thanks for having me on. It's always a blast.